Databricks pursues $5 billion fundraise at record valuation. Data and AI company Databricks is reportedly in talks to raise $5 billion in new funding at a valuation of $134 billion. The figure is remarkable not just for its size, but for the speed at which the company's worth has climbed. Just a few months ago, in August, Databricks was valued at $100 billion. That represents a 34% jump in a matter of months, reflecting the intensity with which enterprises are embracing AI-driven infrastructure. The valuation puts Databricks at roughly 32 times its projected 2026 revenue of $4.1 billion. That multiple is steep, even by tech standards, but it signals how critical the company's platform has become to organizations trying to make sense of their data and build AI systems that actually work. Founded in 2013, Databricks has carved out a dominant position in modern data architecture. Its cloud platform brings together data engineering, analytics, and machine learning in a unified environment. The company's signature innovation is what it calls the lakehouse architecture, which merges the cost efficiency of data lakes with the performance and governance features of traditional data warehouses. This design allows companies to store both structured and unstructured data in one place while running SQL analytics, real-time streaming, and large-scale batch processing all at once. Beyond analytics, the platform supports the full lifecycle of machine learning, from feature engineering and model training to deployment, making it a central tool for businesses scaling up their AI efforts. The company is locked in an ongoing battle with Snowflake for dominance in the enterprise AI space. Unlike Snowflake, though, Databricks has resisted going public despite pressure from investors and analysts. If it does eventually pursue an IPO, market watchers expect strong interest. More than 20,000 customers now use the platform, including major names like OpenAI, Siemens, Rivian, Toyota, Shell, AT&T, and Walgreens Boots Alliance. The breadth of the customer base underscores a broader trend. AI is moving out of the lab and into production across industries, but rapid growth comes with trade-offs. Databricks has reportedly told investors that its gross margin has slipped to 74%, down from an expected 77% as usage of its AI products accelerates. The margin pressure reflects the computational costs of running AI workloads at scale, a challenge facing many companies in this space. To date, Databricks has raised approximately $15.7 billion across 15 funding rounds, with backing from Andreessen Horowitz, Insight Partners, Apollo Global Management, Blackstone, Goldman Sachs, Morgan Stanley, Thrive Capital, and NSC. If this latest $5 billion round closes, it will be a strong signal of investor confidence, not just in Databricks, but in the broader narrative that enterprise AI is entering a new phase of maturity and deployment. How GPT-5 helped a UCLA mathematician solve a 40-year-old problem. Every significant mathematical problem has a story behind it. Someone poses a question, others try to solve it, many fail, and eventually, perhaps, someone succeeds. The story of how one optimization theory question was finally answered is no different, except this time the researcher worked alongside an unusual collaborator, an AI model. Ernest Ryu, a professor at UCLA with 15 years of experience in applied mathematics and optimization theory, was curious about the large language models everyone had been discussing. In 2023, he tested ChatGPT 3.5 on simple math and logic problems, like scheduling meetings across time zones. The model understood implicit constraints, like avoiding meetings between midnight and 6 in the morning, but its accuracy was inconsistent. It showed promise, but Ryu felt it still had a long way to go. When OpenAI released GPT-5 2 years later, Ryu began hearing about its rapidly advancing capabilities in mathematics. He decided to try again, this time with a more complex problem. He did not expect it would lead to solving a long-standing open question in his field. The problem Ryu chose was recognized in the mathematical community as both unsolved and important. His intuition suggested it might have a simple solution, but no human had been able to find it. The question centered on a phenomenon called the Nesterov Accelerated Gradient, or NAG, an optimization method introduced in 1983 by mathematician Yuri Nesterov. NAG uses a form of prediction, often described as looking ahead, to speed up how quickly an algorithm converges. Unlike traditional algorithms that calculate a gradient at the current point, NAG calculates it at a look-ahead point, allowing the algorithm to make a more informed update. By anticipating where a parameter will be rather than where it currently is, NAG helps guide the algorithm more effectively, converging faster and managing oscillations as it approaches the function's minimum. The mystery was this: when an algorithm uses NAG, it becomes dramatically faster. But does the extra momentum affect the algorithm's stability? Unlike a car engine that might fail if pushed too hard, NAG seemed to deliver a speed boost without introducing instability. For decades, researchers observed this behavior but could not fully explain why the method remained both fast and stable. Ryu and several others had attempted to solve this mystery years before, but failed to produce a mathematical proof. As Ryu worked with GPT-5, often late at night after his kids went to sleep, he was impressed with its creativity and unconventional approaches. However, when he checked the model's work, he would notice mistakes in its reasoning. The problem remained unsolved. Still, the model had proposed an interesting approach he had not considered, much like the human collaborators he valued in mathematical brainstorming. That prompted him to push further. Throughout the process, GPT-5 was not inventing new mathematical tools or principles. It was very good at wielding existing tools and finding equations, solutions, and ideas from papers slightly outside Ryu's area of expertise, papers he might not have come across otherwise. It astonished him with the unusual things it would try. Its ability to pull from a massive scale of reading and learning made it particularly powerful. Ryu kept prompting, treating GPT-5 as a collaborator he could bounce ideas off of. It continued to produce creative ideas that pushed him in new and unexpected directions. When he posed a question, the model would offer a direction, right or wrong, and Ryu would assess it quickly. If the idea felt like a dead end, he would pivot immediately. If it showed promise, he would pursue it. The speed of this process condensed what would normally take days into hours. GPT-5 was a very unusual collaborator, Ryu said, in that it would propose something completely out of the blue. The result was a solution to a problem that had stumped researchers for 40 years, achieved through an unconventional partnership between human intuition and machine-powered exploration. Nvidia nearly doubles revenue on strong AI demand. Nvidia continues to dominate the AI hardware market, reporting results that surpassed Wall Street expectations. The company's third-quarter fiscal 2025 earnings reported in November were driven by what executives described as insatiable demand for its AI chips, particularly within its data center business. Total revenue came in at $35.08 billion, up 94% year-over-year, beating the expected $33.16 billion. Net income more than doubled, reaching $19.3 billion compared to $9.24 billion in the same quarter last year. Adjusted earnings per share hit 81 cents, above the expected 75 cents. Data center revenue, which includes the H100 and the new Blackwell AI chips, reached $30.8 billion, up 112% year-over-year. Nvidia confirmed that its next-generation AI chip, Blackwell, is now in full production and shipping to major partners, including Microsoft, Oracle, and OpenAI. CFO Colette Kress stated that demand for Blackwell is expected to exceed supply for several quarters into fiscal 2026, a sign that the company is still struggling to keep up with orders despite ramping production. Looking ahead, Nvidia forecast revenue of approximately $37.5 billion for the current quarter, slightly higher than estimates but indicating a slowing growth rate compared to previous explosive quarters. CEO Jensen Huang declared that the age of AI is in full steam, noting that enterprises are rapidly shifting from general-purpose computing to accelerated computing to handle AI workloads. Despite beating estimates, Nvidia stock dipped slightly in after-hours trading immediately following the report. The reaction suggests that investor expectations have become incredibly high, and simply beating forecasts is no longer enough to drive immediate stock surges. The market appears to be recalibrating its view of Nvidia's trajectory, weighing the company's continued dominance against the reality that even extraordinary growth can't accelerate forever.